So here's how it works. Let's look at a 30-year-old contributing around $10,000 a year. That's going to get him a minimum death benefit of just a little bit more than a couple $100,000. We want the death benefit part of the policy to be small so that the vast majority of that contribution goes into our cash value account. The account value illustrates how much of our payment is going into the account. The surrender value indicates how much is liquid and readily available. The insurance company is estimating will average somewhere around a 6% return on the cash. Like Mr. Burr was saying, we can borrow against ourselves and use that money for anything we'd like. The insurance company will let you get a loan of up to 90% of your surrender value. So if we're putting around $10,000 a year, by the time we're 5 years in, almost all of our money that we've paid in is there, and the vast majority of it is liquid and readily available. So let's say you borrow $40,000 out of the policy to do something else, like buying a new car or a down payment on an investment property or renovating a property. And then the insurance company will charge a small amount of interest, around 5.7%, and we just set up a repayment plan to pay that $40,000 loan back into our policy. Now, as we're doing that, keep in mind, this is just a line of credit that we're spending. We're not actually removing this money from our family economy. So we get to use this money completely tax-free, and the insurance company will continue paying us index credits averaging around 6% on the entire $50,700 balance that we have in our policy. And we're not paying any federal income tax or capital gains tax on the money we're making over here. So we still get uninterrupted compounding over here and the ability to use this money over here and pay it back to ourselves so that we can do the same thing all over again. Follow to learn more.